There's a lot to think about for the startups. Any tips?
I guess the biggest tip for a startup is raise money from wherever you can.
Friends, family, and fools.
I want to start by talking a little bit about, how the funding world has evolved in the region. And Swetal, I know that you've been working in the region for some 20 years. You've been involved in Hub 71. You've been involved in Mubadala. You've seen a lot of these changes. So could you just walk us through what has sort of happened in terms of venture capital funding and how that has evolved in the region?
Yeah, I spent almost more than 12 years with Mubadala Group, and I've seen some changes in the VC funding landscape over here. If you look at a decade ago, I mean, we were like having very few funds over here. Now, of late, we have seen some global entrants are also looking to invest in these regions, and thanks to the regulators like of ADGMs and DIFC, which are attracting global funds to have a domicile here and providing them various interesting or attracting some with incentives packages and all. So I think we'll see more and more funds joining from different parts of the world, and also we are seeing that some sort of regional funds are also mushrooming. We have a plan to launch our own fund next year, which we'll be announcing soon. So that's a positive signs for this the growing startup ecosystem in this region.
Is there anyone who wants to pitch in here with some milestones that we've seen in terms of the development of the funding scene in the UAE and the wider region as well?
Yeah, I'll jump in there actually. Beehive has been going for 7 years now. So before that, I was been in Dubai for like the previous 5 doing M&A basically. So you've seen some significant changes over that time. If you look 7 years ago when we were out initially fundraising, there were literally a handful and probably one handful of VCs in this region. And I think what you've really seen now is like a whole load of new ones coming through and built up. Obviously, the real difference is you've suddenly got an awful lot of money swashing around from Saudi. And basically, the sovereign funds there are pumping a lot of money in, and that in itself is also generating kind of a lot of desire. And it's a classic thing of where you go, it's not 1 + 1 = 2. It's a case if you get 1 + 1 = 3. It's a building and snowballing effect. I guess what's really of interest, if you look at some of the kind of more recent investments that have been going on, the scale and size has been going up. SoftBank finally getting involved in the Middle East off the back of people like PIF putting division fund and so forth. I think it's really interesting that the Uniphonic deal that happened just last week or week before last, that's really kind of like, I think, put some new numbers and sizes on deals that can happen in this region.
And in terms of access to early stage VC funding versus mid stage funding, later stage funding, Catherine, you've also raised quite significant funds this year. Can you tell us about how has that worked in terms of earlier stage and then as you are growing and progressing through the company life cycle?
Sure. So when we started around the same time as Beehive, actually, I think there was really just the two of us, to be honest, in terms of like fintech deals for the funds here to invest in. And at that point, nobody really knew what fintech was. I think there was still real skepticism, which seems crazy now, about digital as a method of transacting for finance. That fortunately has changed. So now it's very obvious that fintech is very much a buzzword. It's very trendy. That means that there's endless angel investors or like small early stage seed funds that are very willing to have a punt at the like 50K, 100K level. That's very disposable, I guess, to a lot of people. So there's plenty of capital available at that early stage. Private equity is still around, obviously, for the late stage companies. But I still think there is a bit of a gap around the sort of follow-on funding point now, which is beyond the capacity of a lot of, your certainly angel investors, your early seed stage VCs, which a lot of this region, because it's a bit smaller and you've got generalist VCs, they tend to do smaller tickets and they haven't necessarily got the capacity to follow on with a 5 to 10 million ticket.
What can we do to actually improve the access to those later stage funding?
So I think, like a lot of the problems in this region, we'd be helped with consolidation. Like, so we don't really need 50 banks here to cater to the sort of 2 million people that the banks are chasing. And the same with VC funds. We don't need 50 tiny VC funds. We need a few VC funds with very deep pockets to make sure that the startups from this region can be funded locally. And that means that the region will benefit rather than, you know, the likes of SoftBank benefiting from the work that's been done here.
Right. And Masood, I mean, you've also been raising funds for Yapp. What has your experience been like? Is it similar, or do you have a different view?
So yeah, obviously we've been raising funds. Obviously I haven't reached the VC stage yet, but obviously we'll sometime next year we will. So we are currently friends and family. We did our pre-series A round. Next year we'll go probably Series A. That's what we're looking at for now. And obviously VCs will play a larger role in terms of how we do it. But I agree with Catherine. We need deeper pockets as we go along, and as the industry is now moving up. I mean, fintech is one, but if you look at edutech and health tech in terms of where a lot of money is being invested in, you need a lot more VCs propelling the future of fintechs.
Right, and Hassan, I want to bring you in as well. You've been leading an early stage VC fund in Bahrain. Why is there a bigger availability of early stage funding in the region compared to later stage funding? What do you think is driving that?
Sure. So our focus really is on investments at the seed stage. That's an area where you think there's a lot of funding, but other than like friends and family and angels, there's not a lot of institutional focus of like VC funds that are focused on the seed stage. So there still needs a lot more funding and a lot more funds and a lot more optionality. Unlike in Silicon Valley, where there's like 400 VC funds all within a 1 hour drive of each other, in the region we've got maybe 20, 30 deals, VC funds that are pretty active. We need a lot more, and we need a lot more in all stages, right? So we need more seed stage funds. We're pretty happy because it gives us optionality. We can invest in any deal we want to see, but you know, there's not a lot of competition. But at Series A, a lot of the new funds that have been established are focused on Series A investments. They want to deploy $2-3 million at that stage. But you know, as you mentioned, there's also a gap at the later stage. There's probably only 3 or 4 funds that are focused on Series B or higher, and generally what we're seeing is that it's international funds that then focus on investments at that later stage into deals in the MENA region, which is not a bad thing because that's actually what happened in a lot of emerging markets in Southeast Asia. The local funds were the ones that did the early stage deals, the Series A, and then but by the time they got to Series B and Series C, it was the global funds that were actively investing at that stage. Same thing happened in India, same thing happened in a lot of other markets. So I think this is sort of a natural progression of how the ecosystem really is. I see so much opportunity at seed stage. Since the beginning of the year, we've reviewed over 900 deals of founders that are trying to get their startups funded at seed stage, and I think that's us being passive. There's probably close to 3,000-4,000 deals every year that are looking for seed funding, and we just need more funds at all stages.
But also one trend that we're seeing globally is that the ticket sizes seem to be increasing, right?
So look, investing at the seed stage is mostly we're investing in founders. We're investing in early signs of traction, maybe 3 to 6 months of track record, but we're really investing in the teams and their ability to execute and build something. But once it starts getting to Series A, there's more metrics, it's real numbers, so the valuations start to be set more along the lines of, what was your transaction numbers, what was your sort of growth rate over the past year, what was your sort of overall sales figure, and it's a multiple of that. And that sort of happens at Series B and C when startups are trying to raise much larger rounds at the $100 million valuation or more. The thing is, we've had in our portfolio previously, we've got at least 10 or 15 companies that are at that stage already, and they're not having a difficult time fundraising because they have the metrics to support that valuation. So that's the important thing. You shouldn't just go and try to fundraise because you want to raise a bigger round. You should go and fundraise because this is the right time, you're at the right metrics, and you're at the right sort of traction levels to raise that large round and that large valuation.
Yeah, and I think it's a lot to do with in terms of how VCs have matured over the years. It's not necessarily only concept funding now. They've gone beyond. It's also about, it's not only about multiples, and VCs generally tend to look at multiples, and at some part of 3-4 years, 5 years, when you go to sell the company, make a lot of money and scale. But they've got a lot more smarter now. So as you rightly mentioned, it's about your EBITs, it's about your OPEX. So they've got detail, and that's where we tend to see that they're coming at later stages of funding.
As startups prepare for that journey, if you're setting up a regulated business, it might take you 12 months, 24 months to get the necessary permits in place. How do you ensure that you can fund that non-revenue period and actually get on board investors who are willing to support you throughout that preparation time?
So, Johnny, as an org, GPS Global Processing Services, one of the core strategy for us is sustainable finance. We empower more than 100 plus fintech entities, startups, banks, the likes of Revolut, Monzo, and all other fintech unicorns, right? So what we have seen is 25% of our customers, they are VC backed. 25% of them are supported by the group org, the banks or retail entities, and 50% are PE and IE backed, right? So my question to maybe Hassan, Shwetal is, we spoke about consolidation in market. Are we seeing a VC consolidation as well?
The region is still young and fledgling. There is a need for more and more VCs, by the way. So I think the consolidation perspective, I think we need to look at attracting more funds over here. Especially, there's a lot of awareness also required at the early stage. We don't have many angels. There are a lot of high net worth individuals here. They invest in a real estate, in a stock market and all, but they still don't understand investments in the angel, like a startup in early stage. And then we need more and more seed funds, and that's what Hassan's funds that are coming into play. And then we have big gap, and then there's a sovereign funds, right? So I think that gap needs to be first filled in, and then I think there's opportunities there.
Right. So we've talked a bit about the big money, the venture capital side of things. On the other side of the spectrum, we also have an issue with a lot of individuals who don't have access to basic financial services. Catherine, I know you've written a little bit about this on your blog. You talk about the so-called poverty premium. Could you explain to us what that means?
Sure. So the poverty premium essentially means the price that people who are poor pay tends to be a lot higher than the price that people who are wealthy will pay for the same or a similar product. So for us, the key one is remittance. If you are a customer who's got a bank account, you have an absolute plethora of online ways and options to be able to transfer your money home. If you are somebody who has no bank account and you are reliant on cash, you have got to walk to the nearest brick and mortar store to be able to transfer money back to your family. If there's only one store near you, that store has a monopoly on you and the other people that live near you, and you have no options. So that's the poverty premium for us in terms of remittance. But it exists, on all kinds of products. Like if you're somebody that doesn't have transport and you have to go to a shop that's a local convenience store, you'll pay double for the same can of Coke that you would do if you were able to bulk buy it somewhere that you could drive to. So the poverty premium exists everywhere.
Well, the question is whether this is also an issue for small businesses. And I mean, this is an area that you've been looking at, right?
That's right, yeah. What we focus on basically is providing loans to small businesses. That's kind of what we do now. You'll find that most of the banks here are very good at taking SME money and getting a current account open for them after a number of weeks, months, etc. But what they're pretty bad at is giving finance. And where they do give finance, it's generally at a, relative to the Western world, extortionate rate. Effectively, almost what you consider credit card rates for what are actually credit-worthy businesses. It's expensive to be an SME here, and unfortunately what a lot of banks are still doing these days is they group all the SMEs into one bucket and then shotgun rather than rifle shooting to find the good ones. And I think that's the issue. We partner with a bank in Saudi, so we know only too well how the efficiencies and so forth do and don't work internally. You just know that the operational cost is so large, basically, that to make lending to SMEs operationally efficient, therefore profitable, a premium has to be charged. Whereas for corporates, where a much larger check is being written, they can basically consume the expenses in a much better way and therefore get the debt at a better rate. So it's slightly different from what Kat was describing with a person basically going somewhere, but it's not indifferent. Ultimately, SME funding here is massively overpriced compared to the price that the bank is borrowing that money at.
How is it possible that the pricing is still there?
Because it is overbanked. It's simple that there are too many banks chasing too few customers or chasing too few good customers that they want. And therefore the customers who do need the help are someone who's left to the side. And that's where we come in, basically. The way we target SMEs, we're looking for the 20% best SMEs. And that's not 20% of the biggest SMEs, it's the ones that are well run, look after their cash flow, can service debt properly, show they're responsible, and actually take on debt properly and then repay it. And if they can do all that and prove it, then basically come to Beehive, you're going to be saving around about 35% compared to the banks. So that's really our mantra. And that mantra kind of goes one step beyond that, which is why when we're partnering with banks, that's really our go-to force. It's all about operational efficiency. It's how can we do things quicker, cut out a whole load of the back office stuff, and go straight from A to B rather than going A, B, C, D, E, F, G. All of those adding a cost basically to getting the money out to the end user.
Right. And I know Jaap has announced recently as well your partnership with Emirates Development Bank. And can you tell us a bit, like, because that's also targeting this segment?
Yeah, absolutely. And I think it's a great handoff to me. Yes, we did tie up with Emirates Development Bank exactly to solve those problems you just mentioned. I think the problems of SMEs start with opening an account. I think that's where establishing the relationship is not only expensive, but also RDS. Average account opening times range from 20 days to 2 months. Yeah, and I'm sure if people in the audience, if you have bank accounts, especially when SMEs, it's not only about onboarding, but it's also about engagement in terms of the monthly fee, the premium that is charged, etc. So we just partnered up with Emirates Development Bank to make sure SMEs not only have an account in 48 hours, as fast as 48 hours, but also no minimum balance, no monthly fee, and that's just the start. You know, we're just scratching the surface, but it was an important problem for us to address. And we just started the journey. Obviously, it's going to move to lending. It's about financing, but also we need to bring in with the app also the innovation side of it. It's not only about the usual take money, charge higher interest rates, and then create all the stress. The whole idea, and this is again backed by Emirates Development Bank, is to how to relieve the economy of this SME stress and make it very more fruitful and worthwhile for this whole ecosystem to function.
What are some of the key challenges when forming partnerships with other actors within the financial services ecosystem, as
I
people
think
call
this
it?
is a very timely question. My dear friend Masood mentioned about his partnership with ADB, right? And that's the start of partnership, right? So we are already partnered with Catherine's company now. We are supporting them for their digital financial inclusion products. And this is just a start. So we come not as a single player in the market, we come with ecosystem players to create network effects, which means whether it is a bank, an SME, processors, program managers, and the who's and who. So it definitely, I'll take it as an opportunity. I'll say this is an opportunity where we can all work as partners, right? As enablers. We call ourselves enabler of enablers. And we believe that VC and PE funds can also be a part of the whole ecosystem.
Shwetal, you and I discussed this a bit earlier, sort of on what does it actually mean? What does the fintech ecosystem, what does it mean? What are the sort of participants that we see in the UAE, and where are the strengths and challenges?
I think it's a good question, Johnny. So I was involving setting up Hub 71 as well. So the idea of building the ecosystem was to kind of create a lot of partnerships, work with the key enablers, work with regulators, government bodies, corporate innovations lab, attract academias, use their research facilities, work with a lot of VC funds, and also engage with a lot of mentors and thought leaders, service providers. So collectively, this is, I believe, is a call as an ecosystem that will help supporting the startups to scale up. They provide access to the fundings, access to the new market, and that is, in my view, is a perfect definition of ecosystem.
Right. The funders are obviously one piece of this puzzle. Masood, if I may ask you, what are the advantages of sort of the partnering with the venture capital side?
I think the key is, yes, as like if you look at Yaap as an example, and I want to keep it more industry-wide, but if you look at Yaap as an example, you do tie up with banks, but you tie up with banks to provide services. You tie up with banks because they're best at things that they do, and then we are good at things as fintechs as we do. But I think venture capitalists inherently are designed, and they got a niche in terms of bridging this gap. If you look at what's happening in the structure and the rules of capital markets, don't necessarily let investment banks or for that matter, even private equity comes very close, especially in the early stages. And that's where VCs play a larger role. You know, who would give money and finance to two guys sitting in a garage, starting and thinking of an idea. And obviously VCs are coming at a later stage. As we all discussed, there are gaps in terms of at what stage VCs come in. But definitely they play an important role in terms of propelling this whole fintech community. But obviously at early stages, you still get to your friends and family, your seed funding. But in terms of when you're just about to scale, and then that's where VCs play a larger role, because they are looking at scale, you're just about to scale, and that's where that is the best partnership at the right time. So the timing of the VC partnership is equally important. It's just not about money in, it's about how we scale together and look at the next steps.
And just expanding upon that, I think the other thing also talking about kind of VCs in partnership is the classic piece of the VC can bring money, what else can they bring as well? And what we're seeing is, obviously, VC puts money in, they generally want a board seat, great. But as a board member, don't just be a passive member, be an active member. And I think, we've certainly seen, and I know other startups have seen the same, where they have a board member from a VC, but actually they're not really actually bringing anything to the party apart from the money at the beginning. And whilst that's obviously very useful, because at the very start, all you need is money, basically. What's really helpful is when then we have the VC who is a board member to actually be active participant and actively do introductions. So some of the VCs here are incredibly well connected. It might be they're connected into other portfolio companies, it might be connected into government, it might be connected into the regulators, but they are generally very well connected. And that's where the real value of a good VC comes, where they actually really activate that partnership. Now, it might be a case of, we as the investee need to ask them their help, but once you do, they actually go after it and do it quickly. And I think that's a really important bit, which a lot of the VCs don't do sometimes.
How do you navigate that myriad of different funds, and whether it's local, regional, global? Should we take in an international investor while they want to hire a ticket? There's a lot to think about for the startups. Any tips?
I guess the biggest tip for a startup is raise money from wherever you can.
Friends, family, and fools.
Honestly, a lot of VCs talk about how they add value here, or do this, or do that. But honestly, the biggest value that a VC can have is giving you your first check and leading you around, right? Money is really the lifeblood of a startup. And if you need cash in order to build up whatever it is you want to build up, your empire runs on basically cash flow, and most of that comes from VCs. So yeah, navigate the whole thing is find whoever's going to give you money and take it from them. But in general, what's also pretty useful is making sure that you don't waste your time and waste the VC's time. That you're targeted about the stage and sector and market that these VCs are focused on. Because a lot of VCs on their website, you'll see we invest at Series A, we invest at Series B, we're seed investors. So you need to make sure that where you are in your journey matches with the VCs that you're reaching out to. Otherwise, it's a waste of time for both parties. Whether to raise money from the region or international, if you can get international money, go for it. But the MENA region is just starting to emerge into the world stage in terms of VCs stuff. Like just now, we're starting to see some of the larger players look at the region, do some deals here. If you get those, then you'll be sort of valued at international valuations. But that's very hard. Like they won't do a lot of deals in the region. They'll be very selective. They'll do 1 or 2 deals a year, maybe, if that.
Right.
So honestly, just raise wherever you can.
We've spoken mainly about equity here. What about venture debt? What's the status of that funding form in the region?
It doesn't exist.
There is no venture debt in the region.
And why is that?
Because no one's decided to set up a fund to do it. Okay, there's the guys at Yas and Spartech. They launched a venture debt fund. Shuruk is trying to do a venture debt fund. There's a couple of other initiatives to do it, but they're still not there, right? So the only venture debt I've seen so far is Partners for Growth. They did a deal, I think it was with Trucker or whatever like that. But venture debt, VC is just emerging as an asset class. So that in itself, people are starting to look to invest in VC. Venture debt is probably a year or two behind. It would be great. We have a lot of fintech startups that are basically paying for a lot of things off balance sheet. So they're using equity to fund debt, which is not a great trade-off. If there was more venture debt in the region, that would be great. But venture debt isn't really that great either. I don't know if you guys have seen the rates that you sort of have to pay. It's like 14, 15% interest plus a couple of percent equity in the company and all of that. So it's not like,
Right.
oh, this is so much better than equity. It's slightly better than equity.
Right.
Yeah, I mean, it's spot on, Hassan. I mean, basically, actually to that point, we actually looked at trying to do kind of like almost mezz debt. So basically, the idea of like doing up to $1 million tickets sort of thing. This was all pre-COVID, obviously. COVID destroyed that. I think interestingly, I think COVID actually was the reason when venture debt could have come out. And if the big funds had actually got their act together, they could have come out and actually helped with venture debt to basically help survive certain businesses. But Hassan's right, spot on. I mean, the venture debt is a million miles, I think, away from where we are right now. I think if it happened, it'll happen through some of the really big Saudi funds, basically, who are basically pumping money in. They can't put that money. They've been given the money. They can't get their money fast enough into the VCs, and therefore debt might be the option instead. But it'd be great if basically venture debt came here.
Right. I'm soon going to go over to the audience to see if you have any questions. So please think about questions you may want to ask. I just wanted to touch upon, before we do that, on sort of incumbent financial institutions in the region. What can they do to support fintechs and evolving the financial services industry?
Allow them to open bank accounts.
Agreed.
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 I can't believe that in this day and age, for a fintech startup that's regulated by the regulator and everything, they can't open a local bank account to do transactions. It is ridiculous. So any incumbent banks out there, just please open bank accounts for startups.
So, since we don't have any incumbent bank representative on the stage, let me play the devil's advocate here. Do you think all the fintech companies in the region have all the ducks in a row when it comes to their, AML frameworks, their risk and governance, so
No.
that they make the banks comfortable with opening an account?
No, they're startups. By definition, they don't have any ducks in a row. They're just getting started. So, but that's the thing. Like, it's something that you have to accept that this is a startup that now has nothing in it ready, but within a year or two could be transaction, tens or hundreds of millions of dollars to the bank.
Right.
You've got to take that risk and do something at the early stages to get the business at the later stages. But no one thinks like that. So,
Catherine,
Yeah, I mean,
please.
I'm with you. Like the amount of hoops that we had to jump through, like to get now money off the ground, to be able to let somebody send 1,000 dirhams like to India. The level of KYC that we do is incredibly detailed. We see every single customer face to face. We have a physical integration with the Emirates ID Authority, so every single time we see an ID, we're checking it's not one that's expired or being cancelled. Yet we still allow people to buy a tower in this country off plan with a suitcase of cash.
I mean, just to add to that, I mean, I think you're also making an assumption actually that banks do it properly. The real concern is that a number of banks are actually almost run by their compliance department rather than commercially run. And we've seen from the interactions we've had with banks that everything's done properly, but actually quite a lot of stuff is still stuck in the Stone Age. I.e., the central bank will have given sign-off, and there will be precedent for it to happen, to use certain databases, let's say, or to use digital signatures, those sorts of things, yeah? But ultimately, the banks themselves, or some of the banks, will have not got up to speed yet, and their internal processes and procedures will not recognise those pieces, yeah?
Right.
Which is where a fintech basically wants to get to, but then at this point in time, the fintech's actually held back. I mean, I think it's a classic thing. Fintechs and banks forming partnerships. Basically, fintechs can crash onto basically what are the rocks of a bank, because a fintech wants to move really quickly, and the majority of banks, despite best will, are not set up that way to move quickly. And therefore, where something like fintech could do something in, let's say, a week, it would take potentially 90 days for a bank to come back with a decision.
Right.
And that is actually one of the most dangerous things, where a fintech assumes basically that because it's in decent conversations with the bank, it'll go through, and it'll go through reasonably quickly. It's a very, very naive assumption once you've been through it 4 or 5 times.
Yeah, and I think we need just to split that conversation into two, So opening a bank account and lending, they're two different things, So, and sometimes banks tend to just view it as one. And that's where this whole 90-day decision process comes, or what you mentioned here. So you're opening a bank account. You can set up limits. yes, inherently fintechs are designed because of high risk, you have no history, but you're not lending, you're just opening a bank account for them to do transactions. So anything related to AML or compliance or monitoring transactions, there's a plethora of tools all across with every bank. There's enough checks and balances, but I don't think that stops anything. I'm not going to make a sales pitch again, but I think try looking at something like what Yap has done with EDB, and this is exactly the reason, because it's only for fintechs. You're talking about freelancers, you're talking about startups. There is a genuine need, and while they are helping the economy by supplying in money in some shape or form, no one opens a bank account for them. So definitely it's a problem to address. And inshallah, in time to come, we'll be looking to address this at a much larger scale.
So I'd like to move over to the audience for any questions that you may have. Are there any questions in the audience? So the question is paraphrased. Why do you think there is such a disproportionate number of unicorns coming from the US? I mentioned the stats in the beginning, it's around 2/3 in the first half year of 2021. Are there any other reason apart from where the funding is?
Scale, right? It's a huge market. It's one market. It's, most people there speak English. It's not fragmented in the same way that this region is. So if you look at the outbound remittance market, in the US, that's worth 140 billion, and this region in the GCC is worth 100 billion. So it's often like a comparable, but in reality, the GCC is very fragmented, and not just by country. Like even within this country, we've got 7 Emirates running their own systems, and that means it's quite difficult for startups to scale in the same way that they can in the US in the same speed.
I think actually the thing you removed from the equation is the biggest part of it, which is the access to funding, right? In the US, in Silicon Valley, there are so many funds that are looking for opportunities. And honestly, that drives valuations, that gets companies to unicorn level, that drives growth. Like that if all of a sudden you had $100 million in your account, you'd be able to use that to generate a couple $100 million in revenues, right? Like you'd be a complete idiot if you didn't. And so I think the funding ecosystem is probably the biggest part of why the U.S. is forming so many unicorns. And I think the second part is probably market, but as a VC, I gotta ignore market all the time because that's just how I look at things. It's teams, right? It's in markets like Silicon Valley, there are founders that have been at startups that know how to grow and scale a business that are then launching their own startups. So they know from like grassroots how to scale and build something to the level of $1 billion company because they've been in one before. Right. Here in the region, no, like who has that experience? And that's why you're sort of seeing this sort of, I guess, the Careem Mafia effect and stuff of, startups that have been founders were at Careem, they saw it grow, so they should know something of how to grow a business. It's not necessarily that they do, but they should. And so I think that level of knowledge transfer and that circular knowledge growth is probably a big part of it. And we've seen it firsthand when we tie up one of our startups at the early stages with a mentor from Silicon Valley that they're doing B2B, and there's a B2B growth mentor that has grown businesses from $1 million to $10 million in revenues. They've done it 3-4 times. They know what to do. They have a playbook. That playbook doesn't exist here. So we can import that knowledge, but it still will take time for that to happen. So, but money's probably the big part of it. Like, I could create a unicorn tomorrow. I could just put $100 million in at $1 billion valuation into a company, and it's a unicorn. But
So one last questions from my side before we wrap up the session. Where do you think we're going to be, let's say, 2-3 years from now in terms of the fintech sector and access to funding, whether it's VC funding or financial inclusiveness?
If you look at where we were 2-3 years ago and roll that forward another 3 years from where we are now, things have got to be positive. As Kat said, basically, fintech wasn't even known about 5-6 years ago. It's now is one of the good things to go into. And I think what's really interesting is actually the evolution of fintech into like fintech 2.0, 3.0, whatever you call it. Things like the buy now, pay later, which is basically coming through very, very strongly, obviously, at the moment. Robo-advisors, which are a little bit probably had their day now. Crypto obviously is still coming through. Anything to do with blockchain is still coming through as well. I think there's still a great desire to do it. So I think that's where you see a lot. And funding, it has to come, basically, because there is desire. And I think basically governments are going to be pushing the cash in.
Right. Thank you for that. I think that's all we have for today. But I'd like to thank the panelists, all of you, once again for coming and sharing your experiences and knowledge so openly with us. And thank you to the audience for coming.